What's going on, WCP Nation? It's Jared Fausnaught. I'm back today with our fourth minicast that we've done to date. Today we'll be talking about rentals. This will probably be the first of several different topics that we go into relating to rentals. Very excited to kick it off. Today I'm with Conor Reilly. He's going to be giving us a lot of insights internally within WCP. He's been working really hard on all of our rental related products, and super excited to come at you guys today with some really good knowledge.
Excited to be here.
Awesome. Well, first of all, shout out to your haircut. You look great, man.
Thank you. It was spur of the moment decision.
Yeah, I feel like the haircut scene since COVID has become much easier to deal with. Just at home, quick buzz, and you're set.
I'll be honest, it's only the second time I've cut it in a year.
That's amazing. So, you're better than me.
It was due time.
Nice. Cool. Well, yeah, man, just diving into this. I thought today we would try to start high level and really just talk about the state of the market a little bit with rentals, what we're seeing, across the industry. And then try to get in a little bit to the weeds on what kind of offering does WCP have as a lender, relating to the 30-year products, the rental products. And I'll try to, steer the conversation, ask you some poignant questions, and hopefully get everybody some solid information. So, what are you seeing out there these days? Obviously we had really a big turmoil in the market with COVID, and I don't know about you, but I saw 30 years take a pretty big whack, around March, April, May timeframe of 2020. How did that all kind of unfold? Like, what did you see?
When, for lack of a better term, COVID really hit, and the markets, really fluctuated and collapsed. For me, that date was March 17th. I remember the exact day when everything.
Was that Friday? It was like a Black Friday kind of thing.
I believe it was. Well, St. Patrick's Day, I believe.
Oh, okay.
And everything just came to a halt. The biggest thing that changed was for investment properties and 30-year rentals, because rental income wasn't being received. So the funds out there for those properties was really pulled back and was being very tight to the chest. We've seen an exodus from the city to single family rentals or duplex rentals in the suburbs.
Mm-hmm.
That has really, really pushed the rental landscape into still performing very well. But that didn't pick up until probably about June, July mark. And it's still happening. So much so that there are new homes being built specifically for rentals in the single family space, which is something that we haven't really seen before. So the rental landscape in the city still isn't amazing or where it was previously. The single family rental space in the suburbs is performing very, very well, and a ton of people are making a ton of money on that. But that's not to be said that the rental space within the city isn't going to come back, because it will.
Yeah, I've definitely seen that. Have you seen any kind of drop in rental income across at least the DMV? His rents mostly kind of stayed on par with where we've seen them.
At this point, it's returned where it was. Even like I said, in June and July, It had dropped roughly 10% in the city itself in DC. But price points are back to really where they were for the most part, because in DC's particular, we're insulated. A lot of people did get a chance to keep their jobs. And people are still expecting the income, and it's still coming in. So we're back to the traditional price points. If individuals were able to take advantage of individuals that were looking for a rental, were able to take advantage between that March and June timeframe. They did definitely get some good price points because landlords were looking for tenants just to get any sort of income, and they didn't know what was happening, so they were going to take whatever they can get. But
yeah, that I did see that dip in rents, and not to go kind of too in the weeds too early, but I think this is a really good time to touch on. One of the main things that we see from the 30-year products that are out there on the market right now is this is very much so an institutionalized product, right? So is it bank debt? No, but are kind of the underwriting guidelines within the realm of kind of the traditional banking process? Yes, with a lot of advantages. So, and we're going to dive heavily into that. But one part of that underwriting piece is obviously getting an appraisal, getting kind of some valuation information to verify and doing, and as part of that, doing a market analysis on the rent, right?
Yep.
So, one thing we look at is like, how are the rents being affected? How are they fluctuating? Because if the market rate of the rent is substantially lower than what you as an investor are renting it out at, that could ding you a little bit on the structure of your purchase or your refi rental. So, but like I said, we're going to get into that more heavily, but these all, like, some of these higher level questions really kind of get down to the weeds about some of the underwriting process and the structure of this product. But yeah, I saw the same thing. This is a very institutionalized product. Just like the mortgage space, right? I think everybody at this point understands that, like, as soon as the ink is dried on you've signed off on your home mortgage, that gets sold into the secondary market, right? Like, that's a very common thing. This is not all that different of a process. And when you have wild swings in market volatility and a lot of uncertainty, which is what you had before all of these government kind of government bailouts that were put in place and passed, there was so much uncertainty in the market that you had a lot of this capital say, hold on, wait a second, let's take a second and step back. Are tons of delinquencies coming? What does the landscape look like? We don't want to be exposing ourselves any more than we already are. And I think that's why you saw this particular product get hit pretty hard. So yeah,
it was the biggest, probably the biggest hit out there, because there was there was money given for forbearances for your own personal home if you're not able to make the payments, but because it's an investment property, the forbearances aren't there.
Yeah.
And even larger picture, and this might even get even further into the weeds, is to think about what mortgage payments actually go towards.
Mm-hmm.
It's not just paying for the home itself. There's huge REITs that invest in different funds that are backed by real estate and backed by these large tranches of, whether it's single family, personal homes, or investment properties. And without those payments coming in, those funds aren't paying their investors. I believe actually the Chicago Teachers Union is one of the largest investors into a huge mortgage REIT.
Yep.
And the repercussions of not having interest payments being made is that teachers' 401ks aren't going to be making any money. So eventually those payments are going to have to be made so that everyone has their retirement funds being paid for.
Yeah. The delinquency rates are pretty high just in general. We're talking about like millions of people that are currently delinquent on payments. And we are watching that closely. This is nationwide, right? We're not talking specifically DC. I do think we're better insulated in our own market, but this is a concern I think everybody's watching, as we continue to see skyrocketing home prices. Does a wave of foreclosures hit at some point in late 2021, 2022? How does that affect the overall national housing market? Again, even with the 2008, 2009 crash, we were better insulated than many areas in the country. So, is it cause for concern and to monitor? Absolutely. Is it worth moving to the sidelines? I don't think we're there yet. I think you're going to leave a lot of money on the table
Absolutely.
in the run up. So
And
I would just watch it.
one thing to consider, and I know this isn't exactly the rental aspect of things, is what politician is going to allow for foreclosures because of a national pandemic.
Mhm.
Local governments are going to try to find a way around those things.
Yeah.
So
Yeah. That's
this is actually a real opportunity for wholesalers to step in and, really show their worth.
Yeah, absolutely. I mean, and I'd be, I'm curious to know how it works in many other MSAs that I'm less familiar with, but DC, wholesalers make up a decent chunk of market share when it comes to finding off market deals and placing those with new investors. And so it's a little bit of an ecosystem here in the DMV. And I do see, if there are foreclosures in this area, it adding more to the supply. So we talked in a couple other mini casts where, this is really a supply demand curve issue, not like a, fundamentals of real estate lending that would lead, to a bubble or a crash or something like that. We've just got a lot of demand, a lot of millennials coming out of the woodworks, ready to buy their first house, having families, and obviously very little supply, which is why the new home builders are doing so well, and why home prices are skyrocketing. But yeah, I mean, you're going to see a little bit of the relief valve probably open up and have a little bit more supply. So very interesting stuff. I mean, we're nowhere near where the kind of 6-month mark, from everything that I've read, is generally what they say the supply needs to be, and we're right around 1 to 2 months. So it's we've got a ways to go before it even just gets to like a normalized level. Cool. So switching topics, just talking about rentals generally, and strategy around that. Again, keeping kind of high level to start. You hear this term BRRRR, right? Everybody uses that kind of as
the go-to.
Yeah, it's like a go-to phrase everybody talks about. For the sake of folks that don't know what that is, as a strategy, that is one thing I wanted to touch on. And I was also curious in that same vein, what are you generally seeing as like a percentage of purchase, like turnkey type rentals versus refinances that are already existing rental units, as far as what we kind of come across?
Should we dive into what BRRRR stands for?
Yeah, let's go there. That's a good starting place.
So it's buy, rehab, rent, refinance, repeat. So what you're doing is you're purchasing a property at low value, put it in the construction funds, renting it out. You're refinancing, pulling cash out of that property, using that cash you just pulled out of your first property to buy a new one. And you do that over and over again. And that is the simplest puzzle piece to building wealth.
Yeah, absolutely. There's this, I feel like in real estate, there's the great divide between people that are like, it's all about rentals, it's all about cash flow, versus people that are like, it's all about the flips and the development projects and large chunks of cash. I think there's obviously room for both of those in every investment portfolio, and maybe you lean one way or another. Rentals are not going to make you rich overnight. Rentals and housing is a store of wealth, and it's cash flow. And you need both. You need cash flow from businesses or your 9 to 5, or flipping houses, right? Those short-term pops of money every month, or however often you get that, supplemented with your rentals. So
absolutely, yeah,
it's all key. Got it. So that's BRRRR. So what do you see a lot? Do you see heavier percentages of investors in the marketplace? We sit in a pretty interesting spot. We see a lot of deals. We see a lot, whether we do them or not, we see a lot of deals, a lot of investors. Is there a lot of refi BRRRR type of products? Are you seeing a lot of purchases?
Honestly, it's a big mix right now. It's all based on the mindset of whoever that investor is.
Yeah.
Right now I have a couple of people who they're strictly only doing purchase rehabs so that they can refi and hold as rentals. because they're anticipating this market, this rental market continuously increasing and performing very, very well. Because if you look at it, because of the price points of homes and purchasing a home, it does price a lot of people out. That's why people are continuously renting.
Yep.
On the other side of things, investors are doing the fix and flip to sell because the price points are so high and they can make a bigger pop per property. So it really is a bigger mindset. What I'm finding is a lot of people are evaluating what is that cash on cash return, and basing their decisions off of that. So going into the deal, understanding that you can do one of two exit strategies in a way, is going to make more money for that individual. And it really is determined by the submarket itself. So a lot of properties in DC right now are fix and flips. They're going to make that big pop, but then in the suburbs, really held on for the rentals is what I'm seeing a lot personally.
Yeah, that makes sense. And some of it too is, if it doesn't fit within the underwriting guidelines of a rental, you have to kind of analyze it both ways, as I mean, you're an expert on this. Like, you're looking at the Dscr, you're looking at credit and all this other stuff that goes into that, and what's the best option. The other piece of this is margins are getting like super thin,
very tight,
especially with wholesalers, and it is what it is. It's, if we didn't have wholesalers, we wouldn't have a lot of the deals that we have. So it's a key piece of the puzzle. We definitely need that. But margins are getting slimmer. And so a lot of people I've seen that were fix and flippers are saying, well, look, this is all we got now. We got to make these rentals work.
Yep.
I can bid higher, keep up with the competition on the buy side, and just make these rentals for the time being.
Yeah.
So.
And with rentals, you're putting in less construction because it's a different type of project. And that also helps because since COVID hit, construction costs went up. Everything is backed up.
Yeah.
I remember someone ordered a fridge and it took them over 6 weeks to get it. So that's something to keep in mind as well, is, how long do you want to be in the project? And does it make more sense for the construction aspect to go quick and keep it as a rental to immediately have a cash flowing property?
Yeah, absolutely. Like, if you're looking at your pro formas out there and you're not like increasing your hold time and your carry costs as a result of it, you're missing the boat on that for sure. Refrigerators, lumber is the worst one, obviously, but yeah, it's all super backed up. So, one thing I want to go back to, you talking about like the whole BRRRR idea, right? So you're pulling out as much of your cash as you can from the deal. You're staying light. You're letting the rental, the property itself, cover the cost, which is really nice. This gets at the heart of one of the reasons why I love the long-term rental product that we're seeing out there, and specifically our own, so much, is the way that it's underwritten relative to bank debt, specifically regarding like not needing the borrower's balance sheet to lend on, and really kind of using the debt to income, or DSCR, of the property itself, not the debt to income of the borrower. And that's like, we've seen people building massive portfolios with this product, that they couldn't have otherwise done at the bank. So have you seen something similar to that? Like,
yeah, I mean, that is the probably biggest differentiator of our type of product versus a bank product, is that, well, first and foremost, we care about the property itself, asset base, and not evaluating that debt to income, because that is a killer for a lot of deals. A ton of real estate investors, they don't show a lot on their tax returns, but they have a ton of properties that they own in entities, maybe different entities, and that doesn't really impact our underwriting of the deal. So this allows a little bit more flexibility in terms of opening up different properties to be able to go for.
Yeah, that makes sense. And whenever I'm talking to an investor, whenever we inevitably get to that point of the conversation, I mean, that always hits so home for most people.
It makes them feel much more comfortable. Okay, we can actually make this happen now.
Absolutely. I'm working with a couple investors on the East Coast that have, multiple hundreds of properties in their portfolio, and this is their full-time job. This is all they're doing. Those folks recognize the benefit of this, and this is the only kind of product that they're using. They're not using bank and stuff. So yeah, it's really key. And as with everything, some of it's a cash flow thing. How much cash do you have to be able to buy more, and how fast do you want it? And those are all kind of goals you have to set for yourself. How many do you want? What's your door number, right? Like a lot of people in the rental space, they have a certain number of doors that they want to hit. It's like, I want 1,000 doors by the time I've retired. Yeah, we see that a lot.
Yep.
So, okay. Switching topics, starting to go a little bit deeper into this whole thing for people. Let's talk like definitions of stuff and like key areas that people need to be thinking about. So as far as when we get, somebody reaches out to us, Connor, I've got this great property. It could be a rental. I'm thinking I'm going to go this route as opposed to, a fix and flip. Let's just say it's turnkey. So we're not involving the complexity of buying it as a bridge loan, doing the construction, and then refining into the 30-year. Let's just say it's already been built and they own it. So it's a refi. They bring it to you. What are you first looking at? What are the key things that they should be thinking in their own mind before they even bring it to a WCP or whoever?
Absolutely.
To keep an eye out.
So what I'll do is tell everyone what they should be thinking about initially, and then go into the true line items of everything that I'm looking at. At the end of the day, what every investor needs to be looking for is making sure that their monthly rental income covers every single part of their potential debt, from principal and interest payments, from taxes, insurance, any sort of maintenance costs, HOA fees. You're going to have a successful rental if your rental income covers at least 1.2 times of all of your debt. So the line items to be considering, and then what we look for as information in order for us to underwrite the rental deal and let everyone know, what LTV we can do, what interest rate, and all of that is going to be your rental income. And on face value, we're going to assume that that's also the market rent,
right?
The annual insurance premium, so how much you're paying for insurance per year, the annual property taxes, any property management fees that you have associated with that, any HOA or condo fees, other maintenance costs. It costs $1,000 a year to mow the lawn or whatever it is, right? Along with your current credit score and your credit score estimate, and your experience of deals. That basic information allows us to start underwriting this property and getting the interest rate and loan amount out to every individual.
Got it. Yeah. And one thing I think maybe trips some people up is like feeling like they have to, it does, when you list it off, it sounds like a little bit of a laundry list. To get somebody a quote, we can use rough estimates as long as people understand that if the numbers change, our quote would likely change, but
absolutely,
it's something that we have the ability to get a quote out. I mean, we're talking, 30 minutes an hour. This is very fast. So we can start with a kind of an initial quote. A couple of questions here. So like experience wise, is this experience of rentals in their track record and that they're operators on, that they have to be part of the LLC or corporation?
So technically, with our rental program, you don't need any experience. This can be your first deal. And that really won't change any of our valuations or metrics or anything of that nature. It's just added color. It just helps when we're underwriting the loan to understand that, hey, we've done this before or not. But no, it's actually not a determining factor on if or what we will do for this loan.
I gotcha. Okay. Very interesting. What are you seeing? So one thing I think is a big hold up for a lot of people is that when they come to me, for example, and they're like, hey, Jared, I got this, I got this potential rental. What's your LTV you can do? it's an immediately a jump to what LTV can you do, what rate can you do, how much cash out. Oftentimes, I see cash outs as a big percentage of the obviously Burr, right?
Yep.
So I see that as a big percentage of these total deals out there, people pulling their cash out. But what everybody seems to miss in this underwriting and this calculation is the DSCR, which is what you alluded to. We didn't say it specifically, but that's what this debt to income of the property calculation is really about. Mm-hmm. And so it's very tough to give a quote to somebody without knowing where the DSCR is going to fall, because you may, for us, and we can get up to like 80%
absolutely
value of the as is value. But, if the DSCR is way off, that 80% may turn into something lower. So it's all a big puzzle piece. And so that's why we need all that information. But
yeah, like you said, our LTV calculation is predicated on what the DSCR is. The higher the DSCR, which is debt service coverage ratio, the higher the DSCR, the higher our leverage can be, because we're more comfortable with that. There is more income coming in for the property than there is debt going out. The lower the DSCR, in that 1.2 to call it 1.29 range, the lower our LTV needs to be, because there's less income covering more debt.
Yeah.
So it's a big sliding scale. So it is tough for someone to come and say, hey, I need to know what your LTV and your interest rate is. And again, because we're not doing it on the individual, but rather than the property, I can't tell you every single time that we're going to get you the same LTV, because it's all property specific.
Yeah, very property specific. So yeah, that's a really good point.
Yep.
What else we got? So getting to the fun stuff, what about what does this all cost people? Like what are we generally seeing as far as rates go on this? And obviously with the big caveat of what we just said, it's deal by deal because of the DSCR.
We can go as low as, I believe it's 4.85, up to probably about 6%. Really what I'm seeing a lot of is really low fives. As you mentioned, it's up to 80% LTV. And then there's 5% adjusters for different things that we underwrite internally. And that's generally 2 to 3 points paid at closing.
Got it. That's solid.
So, I mean, it's pretty upfront with everything that we can do here.
Yeah, really, really solid. And this is, as far as products, probably the most popular, would you say, is the 30-year fixed, fully amortized?
Yeah, 100%.
So we do have some ARM products.
Yep, we have a 5-year interest only with 25 year amortized, a 7-year interest only with 23-year amortized, and a 10-year interest only with 20-year amortized. So at the end of the day, they all are 30-year products, but it's just how are they amortized. The interest only does have a little bit of a kicker. And when we're underwriting the deals, we can provide those options for every individual.
Got it. Okay. Yeah, that all makes sense. What else we got here? So we hit price.
Something that it kind of goes unmissed or goes missed, and not a lot of people want to bring up, especially as a lender, is prepayment penalties.
Good point.
It's pretty industry standard across the board to have what's called a 3-2-1 step down, which means that in year one of your 30-year loan, it's a 3% penalty if you were to pay off. Year two, it's 2%. In year three, it's 1%. That's the 3-2-1 step down of that. So after 3 years and 1 day, it's no prepayment penalty if you were to pay off that loan.
Got it. Yeah, and actually, that's a pretty good strategy. I've seen a lot of people who are kind of really looking for a 3 to 5 year type of product. I've actually seen people doing the 30-year fixed, knowing that they'll get past that third year prepayment penalty, and that's that sweet spot 3 to 5 years, and they can just pay off with no prepayment penalty after that. So amortize in 30 years. So That's a pretty solid option. I've recently talked to a couple people who are really about that. But that makes sense. So what other key areas to look out for, again, talking more in the weeds, that folks should be thinking about here?
If
Uh,
they're
Get
if you're
DSCR.
looking at a condo,
Yeah.
ensuring that it's actually a warrantable condo.
Yeah, I've seen that.
So that is kind of the deal killer sometimes. So understanding that up front before we go through the process is really going to be key, because as of right now, we can't lend on condos that are not warrantable. We're looking to change that. And there may be some ways that we can put you in touch with some lenders that will do non-warrantable condos, but it is a very specific niche type of product.
Got it. Okay. And I think we skipped over credit. What are we seeing generally as far as like a credit range here?
Right now, we're currently at a 680 minimum, which
Okay.
is, again, pretty industry standard.
Yep.
Probably until, October or December, it was actually 700. So we're seeing it loosen up.
Yeah.
I am anticipating that as the market continues to do well and these products continue to perform, that may drop to 660. But we'll have to wait and see for that.
Got it. Yeah, that makes sense. Like a follow up to that, as part of this process, my experience has been that we are seeing some of the insurance and property taxes escrowed. With these products, are any kind of interest payments escrowed at closing as part of this, or usually not?
It's not a requirement, although it's preferred.
Yeah.
So minimum, we really like to see 3 months escrowed, especially for the payments. And that's kind of a good number to start out with. Talking with the individual, maybe it's a cash out. We can talk about doing 6 months. So it's really going to be individualized and how to push that moving forward.
Got it. That makes sense. I'm pretty sure that hits very high level, on most of the deal points that I think investors would want to know about, as they start to analyze their own, rentals. Kind of what we touched on earlier. I think everybody really needs to just understand and decide on, what is your formula for calculating your returns, right?
Yep.
You hear return on investment, you hear IRR, initial rate of return. You hear return on equity, which is basically just cash on cash return. So for every investor out there that's getting started, that's like literally step one. You have to set your parameters, right? Whether you're investing in the stock market, you're investing in real estate, it's a similar process. Like, am I going to go after blue chip stocks? Mm-hmm. Am I going to go after micro caps? Am I going to go after this particular industry? What are those? You're doing the same exact thing in real estate. You're saying this is the tool and this is the metric that I'm going to use to determine, compared to other asset classes, what does my return look like? Rentals versus flips and everything else. Do you see cash on cash return being kind of the big one?
A lot of times that's what it is. Or really, what are they profiting per month?
Yeah.
On this, personally for these, I live by the rule of 7.
Okay.
Making sure that within 7 years, my initial cash down is paid back.
Yeah, that's a really good point. And something we hadn't really talked about yet. We can get more into that in later minicast, but yeah, you have to figure out how quickly are you going to get your money back. I mean, that's why, as much risk as there probably are associated with like the Baltimore rental, they are super attractive because of the cap rates, right? Like, how quickly are you going to get returned all of your cash that you put in the deal? And obviously, if it's a very small loan, it's a very small, purchase price, and a relatively moderate rental amount that often
you get it back quickly.
Yeah, exactly. That's oftentimes guaranteed in Section 8 type of voucher programs.
Yep.
So you can get your return.
You actually brought up a good point. That is a ton of what I'm seeing lately.
Yeah.
Is that clients are doing the fix and flips and fixing things up for voucher programs because that is what's performing very, very well. And if it's not only for us, that is very attractive to large institutional lenders, is seeing that this property is stabilized by voucher programs, by government funded rental entities. So that's a huge strategy.
Makes sense. I mean, when we've got defaults kind of at an all-time high, and people want to know, lenders want to know that their money is secure,
that's as guaranteed as you can get.
That's as guaranteed as we can get. It would take a lot for a city or a county or whatever jurisdiction has the voucher program to massively overhaul and change the voucher system. These are systems that often have waiting lines, like hundreds and hundreds of people deep. And it really has an impact on people's lives. I mean, if you're changing the amount of money somebody can get based on the bed bath count and the square footage, which many of them, that's how they base it on, that can have a real impact on a lot of people's lives. And we see that. I think part of the reason we see that, from what I've seen in DC, specifically DC proper, is just affordability is so difficult. As a community in real estate, we have to figure out ways to allow for more affordability in the city. And I think these voucher programs are one way to do that. Building affordable housing for people. So you're going to only see that as all these home prices continue to rise. The conversation around affordability of houses is naturally going to perpetuate. So
yep, yeah. One thing I definitely want everyone to take away from this. We've gone over the DSCR and all those calculations, but if you're going to be getting into a rental, and you're talking with us as a fix and flip, underwrite it first as a rental, even if everything's an estimate. That way, going into the fix and flip side of things, what the best plan is going to be. If you're doing that afterwards or in the middle, going into the project, you don't have a true guideline of what needs to be completed.
Yeah, that's such a great point. You see it really prevalent with bigger time developers. It's not even a thought in their mind, right? If some big developer is doing a 50 unit multifamily building, they're going to underwrite this based on condos and selling all the condos off versus holding it as an apartment building. Hands down. If they're not doing that, then they're doing something wrong, right? They need Absolutely. To know what the potential exit strategies are. And, wherever you are in your evolution as a real estate investor, even if it's a single, your first single family, you should be having the same exact mindset and underwrite it. Make sure you're not going to get trapped. That's really the big thing. So, Absolutely. But yeah, that's all I really had. We're running a little long. This has been super, I think, enlightening. You're the master when it comes to these 30 years. You got a whole ton of knowledge, a lot of experience around it, and very, very happy to have you on. I'd love to continue this. I think we're going to try to spin this off into a couple other mini casts about rentals and get some more, hopefully some really helpful knowledge and value out to everybody. So really, really appreciate you joining today. And, as always, please reach out to Conor or myself with any of your rental needs or any, hard money related bridge, fix and flip type of loans. You can go to our website, check us out at WashingtonCapitalPartners.com. And we've got forms that you can fill out, put in information about your potential deals. Definitely hit us up, and we're happy to help. I mean, we always try to approach it as how can we add value for you? Yeah. Not just coming to people with our hands open. So we're always willing to do analysis for you, free underwritings, whatever you need. We're here as part of your team. So.
Yeah, absolutely. We're always another set of eyes. I really enjoy this. I'm excited to do this a couple more times.
Cool. All right. Catch you on the next one, guys.
Bye.